Hi, I hope you guys are doing well. It's Granada Vessel here with Virtuous Financial Group. Just wanted to drop in and talk a little more about investment basics. If you have any questions, of course, feel free to reach out to me after this presentation is completed. And let's just jump right in. So today we'll discuss an overview of investments. We'll talk about the different investment account types that are available. We'll also talk about the investment asset types. And then finally, we'll discuss the different asset classes that these different types are split up into. So what is an investment? It's the action or process of investing money for profit or material result. A thing that is worth buying because it may be profitable or useful in the future, and an act of devoting time, effort, or energy to a particular undertaking with the expectation of a worthwhile result. So, when it comes to investing, what are some of the key things that you should think about? Number one, a plan is necessary for your success. Asset allocation is a key component. And finally, start early because time and compounding work in your favor. Also, I want to mention some mistakes that should be avoided. Number one, not having a plan. So just conversely to what we just discussed, not spending enough time on the appropriate asset allocation, excessive trading, overestimating your risk tolerance, lack of diversification, not starting early enough. So what are the account types? If you look at the chart, there's three different categories. There's taxable, tax deferred, and then tax free. So let's talk a little more about that. When we're looking at a taxable account, those accounts, you pay the taxes as you go. So anytime that you sell a security, then you would pay taxes at that time or before the end of the year or following year for that account. Tax deferred is, and I'll try to describe this pretty simply. So if you have a tax deferred account, all that means is that your taxes aren't being paid now. So you would, whenever you put the funds into the account or they're contributed into the account, no taxes have been paid. So once you withdraw those funds, that's when the taxes would be due. Finally, tax-free would be an account where you're putting after-tax dollars into the account. So taxes have already been paid on those dollars. And then once you withdraw those funds, then the goal is to have those funds come out tax-free. And we'll talk a little more about those coming up. And just to kind of go over this chart a little more, under the taxable category, you see brokerage, which would be an investment type of account that can be purchased or opened at a brokerage firm. Registered investment advisors open these accounts for you. Broker-dealer firms is usually who are the custodians on those accounts. When we're talking tax deferred, those are more of your traditional type accounts, such as the 401k. And you see those other examples there as well. And then finally, the tax-free type of accounts would be your Roth account types. So to go into that information a little further, taxable accounts are offered through investment advisory firms and or broker-dealers, and the taxes are paid in the year it was received. For tax-deferred accounts, for profit companies, nonprofit companies, and also state and local government plans offer those types of accounts. The 2019 maximum contribution is $19,000. And if you are over the age of 50, there is a catch-up contribution that is added to the $19,000, which allows you to contribute up to $25,000 for 2019. Employers offer optional matching and sometimes require vesting. So optional matching, if you put in 1%, then your employer may match that 1% as well. Vesting deals with the length of time that you're required to be employed with that employer in order to be able to take or roll the entire balance that you've contributed along with what your employer has contributed with you to another plan, or be able to withdraw it freely. Money withdrawn from paycheck with pre-tax money. So that kind of just goes or reiterates what I mentioned before. Investment options may include mutual funds, self-directed brokerage, which would give you access to more than just the mutual fund menu that you usually get with your employer. So self-directed would give you access to individual stock, mutual funds that aren't necessarily offered on your regular menu. And also, the other investment option may be company stock as well. Some rules that apply to a tax-deferred account is that usually withdrawals prior to age 59 and a half are subject to tax and a 10% early withdrawal penalty, except the 457B plan, which does not have the early withdrawal penalty associated with it at any age. Usually tax-deferred accounts, such as your 401k, 457B, or 403B, offer a loan feature. And the only caveat to those loans is if you separate service at any time, whether it's based on a layoff or if you just decide to leave because you're quitting, then you must pay that amount in full, or you would be liable, or you may be subject, if you're under age 59, to pay the early withdrawal penalty on those dollars. Also, with tax-deferred accounts, there is a required minimum distribution at age 70 and a half. If you fail to adhere to that required minimum, then you are subject to a 50% penalty tax on the amount that you did not withdraw, which you should have. Another tax-deferred account would be offered through the self-employed plans. There is the SEP IRA and the simple IRA. And as you see here, I'm listing the different names of them. SEP stands for Simplified Employee Pension. Simple stands for Savings Incentive Match Plan for Employees. So some of the key features of these two, they're both IRA type plans. However, with the SEP, the 2019 maximum contribution limit is 25% of your compensation up to $56,000. Also, in a SEP, the employer, the employer only makes contributions into the account, and it's at the employer's discretion whether they want to make a contribution or not. For the simple IRA, the 2019 maximum employee contribution is $13,000, which is less than if you were looking at a individual 401k. And for the age 50 plus catch-up, the contribution amount that is allowed is $16,000. Employee contributions are allowed with the simple plan. And there is a stipulation that the employer is required to match up to 3% of the employee's contribution, or the employer has to make a contribution into the simple account, whether the employee chooses to contribute or not. Finally, the individual account. Traditional IRA is the option that is tax deferred. The 2019 maximum contribution limit on the traditional IRA is $6,000. Age 50 catch-up allows you to contribute an additional $1,000, which would put you at $7,000. There are some questions as to whether your contribution would be deductible or non-deductible, and that depends on your income level and whether you have access to a 401k with an employer. It also looks at your marital status as well. You are allowed to do withdrawals in this account, and you still have the same 10% early withdrawal penalty, just like with the other tax deferred accounts. If you're withdrawing the funds prior to age 59 and a half, there's also the RMD requirement, just like with the 401k and other tax deferred accounts. Now, I did want to go back for the SEP IRA. And because you're only having an employer contribution, you are able to contribute to an IRA or an individual IRA as an individual, in addition to the employer-only contributions that your employer would be doing for that self-employed person. And a lot of the information, I don't know if I made a slide with the resources. A lot of this information was found on the IRS website. So I would, of course, encourage you to visit their site to get more information about any of the information that I'm sharing. So the other type that I would like to discuss would be tax-free or Roth contributions. These apply to for-profit, nonprofit, federal, state, and local government, and also individual plans. Contributions are with after-tax dollars. They are non-deductible. So, the goal, as I mentioned, are to make sure that your withdrawals are qualified as well, which means that they would be tax-free and penalty-free. So the rules surrounding that would be that your account has to be held for 5 years, and you have to either be age 59 and a half, you have to be or disabled, or you have to have died, or you have to meet the requirements that you're utilizing the funds for a first home purchase. So the next category or the next area that I want to talk about are the different asset types. I've listed 5 here. There's stocks, bonds, mutual funds, exchange traded funds, which is what ETF stands for, and then finally options. We'll talk a little more about each of those. So with stock, it represents actual ownership or equity in a company. It generates returns through capital appreciation, which means that the stock price goes up after you've purchased it, and income, which would be dividends that company is paying out. There's 2 types of stock, common stock and preferred stock. Most people don't know about preferred stock, or we don't talk about it as much. And a description of it is it's a hybrid stock that trades similar to the bond market, and we'll talk a little more about the bond market here shortly. Stock is usually segmented either by geography, size, style, industries, or sectors. And I won't go into much detail on that, but you see that listed here. Stock is traded on two primary U.S. exchanges, the New York Stock Exchange and NASDAQ. Also, over-the-counter market is available for smaller companies. Usually, stock is purchased through a brokerage firm, and then some companies also allow for you to buy stock directly from them. Stock is priced using a bid and ask system. If you want to buy, you pay asking price. If you want to sell, you get the bid price. In addition to that, some companies choose to pay investors dividends. The next asset type are bonds. Bonds are considered to be loans to a company or government where the investor is paid a certain rate of interest per year. Bond pricing is based on a par value, which is 100, and that represents $1,000. We're back to taxable and non-taxable. Taxable bonds or corporate bonds. Non-taxable would be U.S. government and municipal bonds. U.S. government bonds are free from state tax, but you do pay federal taxes. Municipal bonds are free from both federal and state taxes if you own municipal bonds in the state that you live in. For the different bond types, if we split them based on the different types of bonds, there's U.S. government, there's municipals, and then there's also corporate bonds. U.S. government bonds or treasuries. There's TIPS, which are inflation protected, and then there's also agency bonds, which are sold by the different agencies that are listed here. Munis or municipal bonds are issued by state, county, and city governments. They're used to finance projects such as schools, highways, hospitals, infrastructure, etc. Corporates are issued by companies, and they are categorized based on their bond rating. With all of the investments that we discussed, there are always risks that are associated with them. There's market risk, there's inflation risk, interest rate risk, and each of those are handled in different ways, or there's ways to be able to offset those risks. So when you're dealing with equity or stock, there's some risks that are associated with that. Also with bonds, there are risks associated with those as well. So mutual funds were created to allow investors to get diversification by pooling money of multiple investors and allowing a manager to invest the funds on their behalf according to an investment policy statement. Mutual funds charge an ongoing management fee. They also have other fees that they charge as well. Load, which is a one-time fee paid when you buy or when you sell. That's called, if you pay the fee when it's up, when you buy, then it's called an upfront sales load. And if you pay the fee when you sell, then it's called a back-end sales load. There's also 12b-1 fees, which are marketing costs that are passed to the client. There's administrative fees, other operating costs, and also trading costs. Some of these you may not necessarily see. Some are taken straight from the returns, and then some are actually disclosed on your statement. With mutual funds, there are a variety of asset types and investing strategies. There are two core approaches, passive and active funds. And then another type of mutual fund is a closed-end fund. And it's a little different than your mutual funds because it has a set number of securities within it, if I'm not mistaken. That's why it's called closed-end. The other asset type that I want to discuss briefly are exchange traded funds. They are fairly new. They're similar to mutual funds, but traded throughout the day like stock, unlike mutual funds, which are only traded once per day and are bought and sold based on the day's closing price. Another asset type would be options. Options give you the right to buy and sell an underlying asset at a fixed price at a specified time frame. There's two types of options, puts and calls, and I'll kind of leave this pretty general, but that is an asset type and an option that is available in the markets. So what are the different asset classes? Asset classes allow investors to categorize investments. They're used by investors to create a strategic plan called an asset allocation. So there's there's three major, and then I'll say the fourth would be just an alternative. So there's cash and cash equivalents, equities, and then fixed income. And then finally, alternatives. So cash and cash equivalents would be more of your money market mutual funds, or money market accounts that are offered through your banking institution. And of course, when we are talking investments, just to kind of give a clear understanding, because I did mention banking, any investment that we have discussed through this presentation are not FDIC insured, they're not bank guaranteed, and they may lose value. However, if you are dealing with a bank money market account, such at your financial institution, then those do have FDIC insurance. So just so you know that. Equities would be subcategorized by their geography, their market capitalization, and their style. Finally, fixed income or bonds are segmented or subcategorized by there's TIPS, there's treasuries, there's municipals, there's corporate, high yield or junk bonds, foreign, and then preferred, which is preferred stock, which we mentioned earlier. And then finally, the alternative investments are real estate, commodities, Forex, long, short, private equity, and hedge funds. So we mentioned previously that asset allocation is an important part for the strategic plan of a portfolio. And studies have shown that asset allocation drives 90% of variance in long-term returns. And one of the theories, modern portfolio theory, states that if you fix the risk level or return level and fine, you'll be able to find the efficient frontier mix of asset classes which would optimize the variable that you did not fix. Another key with determining your asset allocation is your risk tolerance, or how comfortable you feel with risk versus your reward. For a greater risk, there is a greater reward. For less risk, there is less reward. So what's next? You can schedule a meeting to discuss your individual situation at a location near you, or either virtually. My information for Virtuous Financial Group is listed here. My email, my web address, and of course, just keep in mind that Virtuous Financial Group is licensed in Texas and North Carolina. So those are the states that I would be able to assist with any of your financial needs that you may have. So that concludes this presentation. Again, if you have any questions or comments, please feel free to reach out. And as always, have an awesome day.